amid growing concerns about economic growth.
Consumer spending was
As
soft.
expected, cut interest rates another quarter point.
We are following breaking news. All three major American stock markets have closed down.
Bitcoin rose 10%.
Even gave the stock market a temporary second wind.
The market reaction, it was kind of nonplussed.
Tariffs going into effect tomorrow.
But the NASDAQ was also.
Investors will be watching closely for more clues about the direction.
It's time to tune out the noise and tune in to great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that move you to be wise and decide well. With your host, Aaron Kolkman, president of Fadir Advisors in Minneapolis. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time with A Steward's View. A Steward's View is brought to you by Fadir Advisors, a registered investment advisor. You can listen to this podcast and previous episodes at fideradvice.com. That's FIDERE advice.com. Now here's your host, the managing partner of Fadir Advisors, Aaron Kolkman.
Welcome back to A Steward's View. I'm Aaron Kolkman. So glad you chose to join us again. And you can find this program online at fideradvice.com/podcasts. That's FIDERE advice.com/podcasts. You can also pick it up on Apple, Spotify, SoundCloud, or YouTube. With that, it's been a big week, and I'd like to give a little bit of a recap in where we've been. Just in this past week, we had Liberation Day, April 2nd, 2025, with major tariff announcements by the Trump administration. And with that, economic outlook revisions have abounded. In fact, they've been mixed. JP Morgan adjusted its economic outlook to include a U.S. recession in 2025. Fund manager Bill Gross gathered attention with his short warning to investors to not try to catch a falling knife. Other economists warned of slowing growth and increased inflation risk, known as stagflation. With jobs, according to the Bureau of Labor Statistics data released Friday, the U.S. economy added a stronger than expected 228,000 jobs in March, increasing from February's gains. The robust gains notched in March were likely a rebound after wildfires and bad weather depressed job growth in January and February. The unemployment rate in March ticked slightly higher to 4.2% from 4.1%, driven up partly by new entrants into the labor market. Economists were expecting job growth to slow to 130,000 in March, and for the unemployment rate to tick up to 4.2%, according to FactSet. With the U.S. dollar slumping about 6% against other major currencies, Treasury Secretary Bessent maintained his strong dollar policy. He insists that we have a strong dollar policy and we are putting in all of the necessary ingredients to make sure the dollar is strong over the long run, quote unquote. He added that, quote, the dollar is going to do great, referring to the Trump administration's approach to reordering global trade and the U.S. standing with its trading partners. In the financial markets, the Russell 2000 took another pounding on Friday, tumbling 4.4% to end at 1827.03. Meanwhile, the S&P 500 fell nearly 6% to finish at 5074.08. The large cap index will have to close below 4,915.32 for a bear market to be confirmed. The Dow Jones Industrial Average was off 5.5%, ending at 38,314.86. The blue chip index on Friday officially entered correction territory, defined as a 10% decline from its recent peak. Further, the Magnificent Seven stocks have led major indexes down, while the equal-weighted S&P 500 index dropped significantly less. In other news, the S&P 500 PE ratio and forward PE ratios aligned for the first time in years, with both metrics hovering near 20, indicating the S&P is more accurately valued. In the bond market, the U.S. Treasury yield curve inverted over the past week, with the 10-year Treasury closing April 4th at 4.04, while the 2-year closed at 4.25. These yields represent a slight inversion and are nearly an exact opposite of the yield pattern 2 weeks ago. And so joining us today is former CEO and founder of Chartwell Investment Partners, Tim Riddle, and also portfolio manager from Chartwell, Theresa Tran. Welcome, Tim and Theresa.
Thank you, Aaron.
Thank you.
Pleasure to be here today.
It's great to have you. Thank you so much for joining us. Our listeners have been interested in this particular segment, and we'll have two, actually, one in the first and one in the second half. You have some big things happening in your part of the market, and I mean specifically small and mid-sized companies. With an increase in volatility this year and pressure on smaller growth firms, how are you navigating this? And I pose that question to either of you, but probably Theresa.
Yeah, volatility has certainly been high across the market, and we've seen a pretty sharp correction and rotation in the market. One of the drivers of this volatility has, as you alluded to earlier, has come from uncertainty surrounding the new administration. And so the regulatory outlook is now leading to, this general ripple effect and questions about what does this mean for economic growth, right? So there's been obviously a lot of discussion about cutting government spending through DOGE, for example, targets of over $1 trillion in spending. And even if much of this is fraud and wasteful spending, it is challenging to remove some of that money from the system without having some implications to economic growth. So if I back up a step, the way that we navigate this volatility is really by being consistent and disciplined with our process. And our process really is to perform deep fundamental analysis of growth companies from a bottoms-up perspective. So what I mean by this is that we evaluate companies. We look at its operations. We look at its growth outlook, its valuation, competition. We are speaking to CEOs and CFOs on a regular basis of the companies that we care about, and just to understand the dynamics of the business. So one important part of this assessment is to gain an understanding of the company's risks. And of late, that means macro risks, right, that has been leading to the volatility. So I'll highlight, a few examples. Right? Tariffs, as you mentioned, have dominated the headlines. We're coming up on Liberation Day. So quite early on, this is something where we assessed our universe, and we actively avoided certain companies. We looked at industrials, manufacturing companies that have high risk of elevated input costs, and commensurately, what does that do to their margins? So we don't know the size and scope of these tariffs. Honestly, I'm not sure even the administration knows yet, but there are certainly areas that have larger targets than others. Other examples, immigration policy. We've avoided some of the home building companies. We do have concerns about their reliance on this workforce and what that means to margins. So that's been a prudent move on our part. So these are the type of considerations that we have as we build our portfolio, and then assess who may have risk, how likely, what's priced in, and then we're continually assessing these risks and sort of build it into our valuation.
Excellent. And so how do you see this approach playing out the rest of 2025 and maybe 2026? Yeah.
So the rest of this year, I think we're effectively, sticking to our process. We use information and moderate our positions as such. So come Wednesday, when we hear about tariffs, there will be information that we have to sort of build into our process. We know that there's going to be a lot of uncertainty that will continue. The markets will remain choppy for a bit here. So we, however, look kind of in fundamental companies. So if you think about the S&P, right? The S&P is down 4.5%, but 7 of the 11 sectors are up year to date. So we still find opportunities across the markets.
And are you seeing those opportunities in a small cap environment and a mid cap environment? Is it both? Where do you draw the line, and does it matter?
We see them across the board.
Okay.
We do. It is obviously more challenging. We see the correction. Small caps have had a correction, but we do still find really interesting opportunities.
Okay. So I'll pose the next question to you, Tim, and I'm kind of jumping on our list of things to talk about, but how do you filter opportunities for BRI? And before I turn this over to you, let me mention what BRI is to our listeners. BRI stands for Biblically Responsible Investing, and there are increasingly many more investors who are aware of this type of investing, and it tends to mean something different in different places. What does it mean to Chartwell in particular with this strategy, and how does it play out?
Well, first of all, Aaron, we have partnered with the Timothy Plan in sub-advising this portfolio for now 18 years. We sub-advise another one of their funds. The Timothy Plan is a terrific partner here simply because what the Timothy Plan has done, Timothy manages the restrictions within our operating universe. So in other words, they let us know the companies that would fall away from our opportunity set each day. In fact, I was just on the telephone with the Timothy Plan a few minutes ago. There is a company in one of the other portfolios we manage that has now become restricted. So they're very active. They work in partnership with us, letting us know constantly changes to the operating universe in terms of perhaps companies that have decided to disinvest certain portions of the business or recalibrate certain pieces of their business so that they'll come back into the universe. But Timothy Plan uses a very strict biblical responsible investing tool, and they use that tool to constantly research these opportunity sets for Chartwell. So they make our job very easy, but we work with them, particularly given the fact that we obviously have our analysts. We'll let them know if we may see something that they don't within a particular company. And again, in an 18-year relationship, there are plenty of opportunities to get to know each other and work very closely together to deliver this biblically responsible investment portfolio to all of the shareholders of the portfolio and the fund.
Excellent. And what an impressive partnership it is. This is the first time in my 20 years of screening risk-adjusted returns in global asset classes that I'm using for clients to find that there is, in fact, a BRI offering that is making it through those screens. Okay. And without going into all the detail, this was an opportunity for me that was exciting to see. It just came this January where the small mid-cap growth strategy made it through those filters and is now not proposing a trade-off to investors, at least those that I'm talking to, where there's this decision point, and that goes like this. I can either take a lower return for what I want to do and be in BRI somewhere in the world, or I can I cannot be in BRI. Right? That's been the decision. So I won't say that about every asset class, but I'll say that about the major ones in my couple of decades of looking for risk-adjusted returns, specifically Sharpe ratios that are better on a 5-year rolling basis. And I've just been so delighted to have this this decision point go away.
It is unique. And it says a lot about the quality of our investment teams with Theresa and with Frank and with Ben on that team, but also working in conjunction with our partner, the Timothy Plan. And again, in these relationships, oftentimes it's just a relationship and it's not a partnership. This is truly a partnership. And it's one of the reasons why we've been able to deliver performance as strong as we have in TAAGX.
Thank you, Tim. Thank you, Theresa. We're going to take a short break. When we come back, I'd like to talk more about the expectations that you two have for small and mid-sized companies in the U.S. and also what opportunities you see that you're most excited about right now. So we'll talk about those things right after this.
More of A Steward's View in just a moment. Investors have stocks, bonds, mutual funds, ETFs, options, futures, real estate, and more. There's one place to look at all of your portfolio. It's called Fusion, Portfolio Aggregation. No contract, no hassles. Fidier's portfolio technology gives its users a chance to see all of their assets all the time, wherever they are. The Fusion platform is open for use without a contract and without a hitch. It's based on mean variance optimization and analysis research by Aaron Kolkman. Fidare uses the Fusion platform to optimize assets for its clients. For more information, visit fidareadvice.com and click on Fusion at the top of the page. That's Fidare Advice, Fidere advice.com. Now back to A Steward's View with your host, Aaron Kolkman.
And we're back with Chartwell Investment Partners, Tim Riddle, CFA, and Theresa Tran, CFA. Tim is the former CEO of Chartwell, now senior advisor, also a founder of the firm. Theresa is a portfolio manager for the small and mid-cap growth strategy that's sub-advised for the Timothy Plan. That's TAAGX, Tom, Apple, George, X-Ray. Welcome back, Tim and Theresa.
Thank you.
Thanks.
So I have a couple of questions for you, Theresa, and Tim. Obviously, your input is more than welcome. First, what expectations do you have for small and mid-sized companies in the U.S. In the years ahead? You know, it's been a weird time to be invested in these areas as big caps have taken off over the past 2 years. And so what do you see happening that's maybe different than we've seen in 2023 and 2024 for small and mid-sized companies in the U.S.?
Yeah. We, in the short term, we expect the market to remain a bit choppy here, right? Regardless of your views on the new administration, the fact is they're looking for a lot of meaningful change in a short period of time. And so this level of economic certainty probably will take a little bit of time to play out. But if I really take the broader view of small caps, I mean, despite this correction, we continue to find many investments that are experiencing really high growth rates and executing very well in the environment. So, if you look at our portfolio, our average 12-month sales growth is 17% across our companies, which is strong, particularly in light of kind of the backdrop here. And if I take sort of the 30,000-foot view in general, I mean, small and mid-cap, we view this segment in the market as an area that still remains ripe for active management. It's one area that we still see that has inefficiencies. We continue to find investments that are undiscovered by investors. And, as you said, in the last 2 years, I mean, the market returns have been really generated by the Magnificent Seven. And, as we see perhaps either a broader distribution, I mean, if we look at the S&P equal weighted, it is outperforming the S&P 500. So we are seeing a little bit of broadening, and I do think over time, perhaps as we see fund flows there, we could see it come to small caps. If you look at relative valuation, small caps are relative to large caps still below historical averages. So I view this volatility as an opportunity for us and for small cap investors. I mean, in small cap where we've seen greater correction, we're seeing broad degrossing. It's really presented some dislocation in the market where, the baby has been thrown out with the bathwater, and we see some really compelling opportunities.
Excellent. And so what are the opportunities you're most excited about right now?
Yeah. So, in general, we get most excited about these companies that can deliver growth irrespective of market growth, irrespective of GDP growth. And so, these are the companies that have, that's the beauty of small cap. I mean, these are the companies that have idiosyncratic drivers, right? They're seeing either secular tailwinds, they have self-help stories, and we find those often to be the most attractive investments. So I can highlight one area. So one area that we're extremely excited about is in healthcare diagnostics space. This is one area where we're seeing just incredible innovation, new product advancements, and just as background, there's this new era of oncology testing that's still in its infancy. And so we see a huge runway for growth. It remains underpenetrated. And I think over time, some of these diagnostic tests will become standard of care. And really, what I'm referring to are these companies that have cancer detection tests. These are via a blood test. It can provide early cancer detection at a molecular level, often for patients that are in remission and facing reoccurrence. And it can lead to an earlier diagnosis than traditional imaging. I mean, these are industries that are seeing tremendous top line growth. They have no tariff exposure. They have limited policy risk. So these are the areas that we just love. So that's just one example that we're kind of excited about right now.
Excellent. And how is it that risk gets managed in your process? If you have a summary version of that you could share with our listeners, either Theresa or Tim.
Yeah, I can have Tim chime in here too, but a lot of our risk, we do monitor our factor exposure. We look at really relative to historical and how we're sort of balanced versus our historical, and just to ensure that we're in line. And a lot of it, I think, is also dependent on each company analysis. Again, at its core level, we are kind of focused on our bottoms-up process, and so we do look at our risk-reward, our upside and downside capture, and particularly just within each stock as well.
Excellent. Tim, any thoughts?
We're very conscious of limiting exposure, particularly at the high end of the portfolio in terms of concentrations, be it within any individual industry or an individual weight within the portfolio. That will create a situation where we're spending a great deal of time trying to limit the potential downside associated with either one of those issues.
Okay. And in terms of current holdings, has much changed lately? I look at turnover in the past trailing 12 months through February anyway, at about 95%. So that doesn't speak to March. But I am curious if you've had a lot of changes since, the list I have shows Marvell Technology, Deckers Outdoor Corp, Burlington Stores as the top three.
Mm-hmm. We've had, obviously with the uncertainty in the market, we have had some turnover, obviously, as we get new fundamental news. So we've had some moves, a little bit on the AI front, and then more individual moves. We've added some healthcare that has more defensive characteristics, right? Mm-hmm. That we think is a little bit more protected in this environment.
Excellent. And 71 million right now, is that right, Theresa?
Yes, that's correct.
71, correct.
Okay.
Yeah, sorry, Aaron, you couldn't read it.
Okay.
In AUM managed, correct.
Yeah, and I know the firm is managing 12.5 billion. What is it about this fund that we haven't touched on that you'd like investors to hear, Tim or Theresa?
Yeah, I don't know, Tim, if you want to jump in here, but I think what really shows, if you look at our historical attribution, is that much of our returns comes from stock selection, and not from taking larger sort of sector bets. It truly is a stock picker's portfolio, and driven by our fundamental process. So that is we look to drive our alpha and our returns from alpha as opposed to beta in this instance.
Tim, what are your thoughts?
Theresa's comments about the attractiveness of not only the universe, but just as Theresa had laid out, the portfolio itself. We believe this is an extremely attractive portfolio at this point in time, and are very excited about the prospects. Regardless of what happens in the market, there's going to be short-term volatility. And again, we knew with the new administration that there would be some volatility associated with the market, but longer term, this is a very, very efficient sector to be invested in.
Excellent. And the number of holdings right now?
There's 40. I should have this 41.
Okay, so a fairly concentrated portfolio.
It is.
And I can also say congratulations. You've made the top quartile, at least according to Morningstar, the past 3 years. Theresa and team, well done.
Yeah.
Okay, well, it's been such a pleasure to have you on the program today, and I just want to thank you both for your time and your inputs. We've been talking with Tim Riddle from Chartwell Investment Partners, also Theresa Tran from Chartwell Investment Partners. Theresa is co-managing the TAAGX fund. That's the Timothy Plan Small Mid-Cap Growth Fund, and they are both appreciated, and we'll gladly invite them back at some point in the future. And you can find Tim Riddle and Theresa Tran at Chartwell Investment Partners. That's chartwellip.com. You can find the Timothy Plan at timothyplan.com. Tim and Theresa, thank you both again for your inputs. And looking at the week ahead, on Wednesday, we have wholesale inventories and the Federal Open Market Committee meeting minutes. Thursday, we get initial jobless claims as well as the CPI inflation report. For CPI, estimates are for the headline number to grow at 0.1% and core to grow at 0.3%. Then on Friday, we close the week with PPI data and April preliminary University of Michigan sentiment data. I do hope this program has been a benefit to you and others you choose to share it with. From all of us at A Steward's View, we look forward to joining you next week. And until then, please do be wise and decide well.
You've been listening to A Steward's View with your host, Aaron Kolkman, president of Fidere Advisors. To learn more about Fidere Advisors or speak with Aaron, visit fidereadvice.com. That's FIDERE advice.com. While there, you can also enjoy the free Fusion platform for portfolio aggregation. Just click Fusion at the top of the page. To listen to this and other episodes of A Steward's View, visit the website Fidere Advice and click on A Steward's View podcast link at the top of the page. Fidere Advisors is a privately owned full-service life planning firm offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plans for families it serves. Fidere maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions and is for informational purposes only. Fidere and its representatives do not offer tax or legal advice through Fidere. Please consult the appropriate advisor. Fidere Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidere, please visit fidereadvice.com. That's FIDERE advice.com.